To Dr. Samir now.
Good evening, friends. So COVID-19 continues to be center stage and be of significant concern to everybody, both in terms of lives and livelihood. And in these challenging times, AOI along with Plantrich has brought to you these two power-packed seminars on rewriting your money story. So in the first part of this series, which was on the 2nd of May, we had this wonderful presentation by the Chief Financial Coach of Plantrich, Ms. Khyati Vasani. And to bring back memories from last week's show, she emphasized the importance of creating a wealth pyramid by building a pipeline and not just by carrying daily buckets. So that was something that she emphasized. She also highlighted on the ways of maximizing our wealth, the importance of which has been highlighted during this so-called Black Swan event. She explained very, very eloquently that our wealth demon is inflation and our wealth terminator is procrastination. But most importantly, our wealth journey is the power of compounding. So it's extremely important that you not only spend time in how to put your money to work, you also spend time in the markets rather than just trying to time the markets, which is what someone, most of the time people try to do. So now after that very lovely session last week, we had a lot of queries which were received, and Plantrich has been answering these on your personally on your emails. So the last session was a foundation layer. So this session will help you build on that foundation. And today our speakers will be focusing on helping you plan your finances. Asset allocation is one of the most important things in any portfolio. But it's important for us to learn how to do that. And we should be focusing on that aspect basically today. And for that, we have this amazing line of speakers for this evening. Before we go on to our speakers, let me just remind you that please keep posting your comments, your feedbacks on this session and on the chat box so that we can take this up during and then later on after the session. So I hand it over now to Dr. Kaushal Sheth to introduce our first speaker for the evening.
Thank you, sir. Ladies and gentlemen, imagine having a career at Wall Street. You're 25 years old, and then you move to India to start a mutual fund business. This was early 2000s in India, where things were not as rosy as they were today. Ladies and gentlemen, it's my honor and privilege to introduce Ms. Radhika Gupta. 17 years ago, Radhika came back to India with a dream and with an experimental instinct of thriving in chaos, which led her to become the CEO of Edelweiss Asset Management, one of the country's largest mutual fund houses. Post this seminar, please do visit her YouTube channel and see the girl with a broken neck. This video has gained more than 10 million views. Radhika believes in contrasting all the adversities that she has faced in life, and she has come out more learned with each and every event. Over to you, Radhika, for an enchanting session on mutual funds and equities and debts and whatnot. Thank you.
Thank you so much. Good evening to the everyone present on this call. And I must confess that over the lockdown period, I have probably spoken to over 20,000 people, done hundreds of webinars, but I don't feel as privileged as I have in the past as to do anything like this. Thank you, Dr. Kaushal, Dr. Samir, and Khyati for giving me this very incredible opportunity to speak to our medical fraternity. And before I can say anything on behalf of the entire team at Edelweiss Group and Edelweiss Asset Management, a really heartfelt salute to what your fraternity is doing for all of us through this COVID crisis. I think it's unforgettable, and it's a real privilege to do this. I am going to try and keep my remarks brief. And I'm going to try and keep the technical language out of it. We finance professionals love jargon, so let me try and keep that out. But I think Dr. Kaushal started, with my introduction, and he talked about the times on Wall Street. And before I get into anything finance related, I always believe that, in markets and the kind of environment that we live in, while history doesn't repeat and no crisis is like the past crisis in market, history definitely rhymes. I mean, I keep joking with my husband that in Wall Street times was so busy that in the last crisis, we never left the office. And this crisis is a strange one because we're not even able to go to the offices. But I really learned everything I know about asset allocation from a very personal encounter in 2006 and 7. And I want to share that with you. So I was about 24 or 21 actually, when I graduated from Wharton and I started earning my first salary. Some of you are young doctors on this call. And I started investing in the markets in 2005 and 6. And you have that confidence of young financial professionals कि मुझे तो सब कुछ आता है, I know everything, nothing can go wrong. So what I did is I put 100% of my allocation, my money, into equities. This was hard-earned bonuses. These were all put into equities. And I also, there was that old thing that, if you are young, then you can take all the kinds of risk in the world. So just go put everything into equities. And it was fantastic. 2005, 6, 7, life was great. Then 2008 happened on Wall Street and markets were down 50%. So my own personal portfolio was down 50%. And this is very embarrassing to admit as a capital markets professional, but it felt pretty horrible. I mean, it really felt very, very horrible. We felt the world was going to end. It was also exceptionally tough at that time because, as a Wall Street professional, bonuses were down. There were no bonuses that year. Jobs were under question. And I was married to someone, like many doctors, often married to doctors. I am married to a capital markets professional. Incidentally, the same thing happened to him. So our family wealth actually collapsed by 50% in that crisis. And that was a very, very telling lesson for us and something that we've never forgot. And one of the things that I learned from that episode is that, money is a very, very personal thing. And I think you've covered it. But one of the things that you can't do is clearly put all your eggs in one basket. People talk about things like asset allocation. When my money was down 50% because I had invested 100% of it into equities, it was very difficult for us as a family to go through. And I think, asset allocation in the basic terms is just not putting all your eggs in one basket. It's putting some money in equities, which are wealth creating and long-term instruments. And I know you'll talk about equities later on this session, but it's also about putting some money in debt, because in the bad times, markets will be down 20, 30, 40%. In fact, in my lifetime, and I consider myself reasonably young, I've seen markets down 30% thrice. So in these times, debt is the cushioning factor in your portfolio. And I think that's very, very important. Investing is not a difficult job, especially compared to what you all do. But one of the important things about this journey of finance that you will embark on or that are you part of, that is very important to stay invested. And the most practical, there are two very practical reasons I learned for doing asset allocation. One reason is that, when your portfolio is down 50%, the world begins to end around you. You feel angry, you feel agitated, etc., etc. When your portfolio is down 10, 15%, you are there to fight another day. You can live to fight another day. And I think asset allocation does that. The second is, and COVID is an exceptional time, asset allocation also gives you liquidity in your portfolio. And that's something that we can talk about a little later. Times like this bring up expenses. Sometimes for all of us, in various professions, jobs are under question, families are under stress. If you don't have a sensible asset allocation and you were 100% in equities, unfortunately, if you needed money today, what you would have to do is go redeem money from your equity portfolio. You have notional losses that are probably 20, 30% red. And by hitting that exit button, because you need the money and you can't do anything, you need the money, so you need the money, you make those notional losses real losses. And that is the other thing asset allocation solves. So at a time like this, if you did some asset allocation, you had some money in equity and you had some money in debt, then if you needed money, you could take out the debt portion of your portfolio without worrying about, is it a good time in the market? Is it a bad time in the market? I actually, when I moved back to India, because I did not do the asset allocation in 2009, had to redeem all my equity money at a 20-30% discount. And it wasn't a great feeling because it is hard-earned money. So I think that is the real case to do asset allocation. The third learning, and I think you all talked about financial planning in the last conversation, is that when you make decisions about money, and we'll talk about debt next, is that money is very personal. The right answer for Dr. Samir versus Dr. Kaushal versus me versus Khyati could be very, very different. You know, if my husband was a doctor instead of a financial services professional, I would be far more aggressive with my investments. But because we are both in high risk industries, as far as their linkage to markets are concerned, we are a lot more careful because we know our jobs are so high risk. So please, when you plan your finances and everything, take everything I say in that context, please make decisions that are personal to you. You are not your neighbor, you are not your parents, you are not Warren Buffett. Everybody has a different set of circumstances. And I think it's very important that any decision you take is in context of your circumstances. So that is asset allocation, I think, in a heartbeat. Asset allocation comprises of equity and debt. And today I'm going to focus on debt. Now, when we as Indians think of debt, we think of two very simple categories. जब हम बैंक में जाते हैं, we think of safety money that we put in a savings account that we may need for any kharcha. That could be money we need in a day. That could be money we need in 3 months. That could be money we need in 6 months. Okay. The second kind of money we think of is money that we may want to put away for 3 years or 5 years for some purpose. But for whatever reason, we don't want to put it in equities. For instance, if I had to educate a child abroad and I needed this money in 3 years, I don't want to take risk with that money. So what have we typically done with that money? We've done a 3-year FD with that money or a 5-year FD with that money. So these are the kind of 2 buckets of money that you have. Money that was traditionally your savings account money, and money that is a little long term and is your traditional FD kind of money. And for both these kind of solutions, what I'm going to talk about is the use of debt mutual funds. Now, there has been a lot that has been said about the whole debt mutual fund space and category, depending on how much you follow. Essentially, in very basic terms, a debt mutual fund is a vehicle that invests in bonds of companies. The bonds could have various lengths. So you could be investing in 1-day bonds, you could be investing in 10-day bonds, you could be investing in 30-day bonds, or you could be investing in 3-year bonds. You could be investing in bonds of Government of India, which are completely sovereign. You could be investing in bonds of very good public sector companies like National Highway Authority of India or National Housing Bank of India, etc. Or you could be investing in bonds of corporates and maybe not so good corporates. So this is the range, and that is what debt funds do. The reason many people talk about debt funds is, a common question that you say is, जब मेरे पास FD है तो मुझे ये debt fund करने की, why do I need to even get into this? Debt funds become very, very tax efficient for you. If you hold debt funds for more than 3 years, you get the advantage of capital gains taxation. Now, if you're a medical professional and you hold an FD for 3 years, you pay the highest marginal rate of tax on that, whatever that is, 30-35%, or whatever your applicable rate of tax is. If you invest in a debt fund, you pay indexation. So if you earn, say, 7%, you will pay 20% tax on the gains above the rate of inflation. So let me just explain this once. Sometimes indexation is clear, sometimes it's not. You earn 7% return, prevailing inflation is 4, 7 minus 4, 3% pay, you will pay 20% tax. That's about 0.6% tax on 7%. So that is about a 10% rate of tax. So your post-tax returns, because of the structure the government has given you, are far better in debt mutual funds than FD. And that is why it is very important to look at this asset class, because we all work really hard. And when there are sensible ways to save tax using these non-traditional investments, then we should look at that. There are 2 questions that come to me. One is, are debt funds safe? There have been, and some of you have seen, some of you have not seen, there are a lot of news, rumors, speculations about the debt fund market. And my simple answer to this question is, if you choose the right debt funds, and there are a lot of them, then debt funds are safe. Please do not take a single of few, and we can take this in a Q&A, single of few instances that happen and allow them to color the entire debt fund category. One of the challenges is because hum log FD mindset se aate hain, we come from an FD kind of mindset. We have never learned that what can go wrong and how do debt funds move up and down. Very simply, and I'm talking to a group of super smart people, there are two things to keep in mind in debt funds, and then we'll talk about how to use debt funds in your money. Debt funds can be of different length. So as I said, you can have 1 day, 3 day, 5 day, 7 day. There is something called duration risk. So as interest rates upar niche jate hain, debt prices also move. So if interest rates go up, your debt fund will lose money temporarily. The way to avoid this risk is, if you had to do, as I said, if you needed to park money for 3 years, please park money in a debt fund that holds 3-year instruments. If you needed to park money for 3 months, please park money in a debt fund that holds 3-month instruments. Then this duration movement, because of interest rates moving up and down, will not bother you at all. The second risk, which is the one that has been in the news a lot, is something that we call credit risk. Credit risk is basically the risk, as all of you understand, you lend to various. So if you lend to Government of India, you don't worry about your money coming back, of course. If you lend to very, very good quality corporates or public sector companies, hopefully you think they will not default and you don't worry about the risk of that coming back. If you lend to slightly poorer quality borrowers, but they give you a higher rate of interest, they have to give you a higher rate of interest, otherwise no one will give money to them. Then sometimes you have, in extreme market conditions, worry about money coming back. The simple way to solve for this risk is not to try and lend to poor quality or invest in funds that look at that. Just focus on high quality instruments, and any advisor can guide you, but focus on the highest rated things. See, when you invest in debt, now you invest for safety. So sometimes people ask me, with interest rates going down, to earn 1% more, should I try this, should I try that? Debt is not the place to get experimental or clever. It is the place to do basic things. If you want to take risk, please take risk in your equity investments, because equity is a risk-taking asset class. Debt may, and especially I'm saying when interest rates are coming down, don't have the temptation to just say, for 0.5% more, let me do a subpar borrower, or let me do something that's not suitable. It is not worth it. Now, we are the mutual fund industry, and sometimes we tend to complicate how to use debt funds. But how do you use debt funds to actually plan your money? So I have a 3-pronged strategy that you can write down, and it's the easiest thing I do for my personal money. So I divide my money into 3 kinds of buckets today. Money that I need for less than 3 months, money that I need for between 3 months and 3 years, and money that I need for more than 3 years. And I'm going to talk about how you can use debt funds in each of these buckets. And I've broken these down because of the structure and the taxation norms in India, so that you can also get the different benefits of taxation. For money that you need for less than 3 months, my recommendation is you use 2 kinds of funds. These are overnight funds or liquid funds. Liquid funds invest in 1 to 2 month kind of securities. They invest in the highest rated, which is what we call A1 plus borrowers. Liquid funds are completely safe. They are like putting money into your savings bank. You can get your redemption the same day, so there is no problem. I think a savings bank rate today is sitting at about 3. I think my savings bank is probably at about 3.5%. A debt fund, a liquid fund, will probably be at 4.5%. Even with the marginal rate of taxation, you tend to be better off in a liquid fund. If you are super paranoid, if you want to be really paranoid, there is also another alternative to a liquid fund. It is called an overnight fund. That basically gives money to Reserve Bank of India for 1 day. 1 day. So no duration risk, no credit risk. It is called an overnight fund. आप पैसा डालिए, आप पैसा निकालिए. तो 3 month के अंदर में there is nothing, and regardless of which mutual fund you pick, if you pick any of the top 20 mutual funds and you pick their liquid fund or their overnight fund, I don't think anything is going to go wrong with you, Edelweiss or non-Edelweiss. So that is under 3 month money. The second part that I want to tell you is 3 month to 3 year money. Now, remember that under 3 years, and I picked this 3-year point, under 3 years, if you invest in a debt fund, the taxation in India is over 3 years, you get that 20% rate of indexation that I talked about. Under 3 years, you pay short-term capital gains on debt fund, which is full tax. There is, however, a category of funds, and I'm glad Khyati asked me to talk about it. I also use it for my personal money. It is arbitrage funds. These are funds that give you debt-like return, but they have the taxation of equity funds. So over the last 3 to 5 years, arbitrage funds have typically given you somewhere between 6 and 6.5% pre-tax. If you hold them for less than 1 year, in the growth option, you will pay 15% tax. If you hold them for more than 1 year, you will pay 10% tax. On a post-tax basis, you are still at 5% plus. Arbitrage funds that are well managed do not carry any significant credit risk. They do not carry any duration risk. They basically invest in arbitrage of equity companies, but they give you debt-like returns. So this is one recommendation I have that you look at. If you're not comfortable with that, you can also look at ultra short-term kind of funds. There you should just do the diligence as to what kind of credit quality. But my favorite pick in the 3-month to 3-year category has been arbitrage funds. If there are more questions on this category, I'm happy to take it in the Q&A. Above 3 years, you have the benefit of taxation. I think you can look at 2-3 categories in mutual funds. There is something called a bank and public sector. Sorry, our names are complicated. Bank and PSU debt fund. It invests in companies and bonds of banks and public sector companies. I don't think anything will go wrong there if you do anything like that. So you can look at banking and PSU debt funds. You can also look at some corporate bond funds that invest in bonds of good quality borrowers. Most of these will have a 3, 4, 5-year kind of tenor. Today, the good thing is also that if you wanted to invest, as I said, if you have 3-year money, you should invest it in things with 3-year bonds. If you wanted to even look at products with 5 and 10-year duration, for instance, we run a very popular Government of India product called Bharat Bond that has a 10-year duration, or a banking and PSU debt fund that has a 10-year duration. You can also look at 10-year products. So आपको 3 की need है तो आप 3 करिए. If you need 5, then you do 5. If you need 10, then you do 10. So that whole range is available. But the broad point, again, to summarize, is less than 3-month money in liquid and overnight funds. 3-month to 3-year, I tend to use arbitrage funds. 3-year plus, you can look at banking, PSU, corporate bond, and you have the nice advantage of taxation. So that is really the debt fund landscape in a quick nutshell. Khyati also asked before the Q&A to leave you with a few thoughts as an investment professional as to how I would handle things in this kind of market. And I thought I would end with that. I would say, guys, that whether you're investing in equity or debt, markets are volatile. They will be volatile. If this is your first time doing equity investing, for instance, do be grateful for this experience. This experience is also a very good time to figure out your own risk appetite, what works for you and what doesn't. Honestly, we don't understand our appetite for risk in a good market because we're all making money. It's this kind of market where we actually start to ask these questions. So work with your financial advisor and ask these questions. As I said, I learned my own lessons in 2008. If you're going through it for the first time, this may be the time when you actually learn your own lessons. Once you learn those lessons, you can apply the asset allocation principle I talked about and figure out how much equity and debt you need. Second tip I would leave you with that you were talking about last time is, again, that in the word personal finance, personal comes before finance. So make sure that your planning is very personal to your circumstances. And third, these are difficult times. These are stressful times, perhaps more for your fraternity than anybody else. One of the best things I was taught about markets is that a storm is often not the best time to take great strategic decisions. So if you're feeling panicked, if you're worried, sometimes this is not the best time to take decisions. If you don't want to add, if you don't want to subtract, don't do that. The best thing you can do sometimes is just to do nothing and stay calm. The news doesn't really help us do that, including in financial media. But my request is that you stay calm. So I'm going to just end there, Khyati, and I can open it up now for questions.
Thank you. Thank you so much, Radhika, for such enlightening session. It was really wonderful. So I'm just going to summarize in 5 points and highlight the things that we've learned from you. So first thing is, do not put all your eggs in one basket. The second thing is that asset allocation, when you ensure asset allocation, it also gives you liquidity. Do not convert your notional losses into real losses by, exiting in panic. Don't invest in poor quality, always focus on going for a good quality. Debt is definitely not a place to get experimental. And break your money into 3 buckets: 3 months, 3 years, and more than 3 years. And according to that, plan your debt investments. And also, debt is very tax effective as compared to different debt options that are available. Debt funds are quite tax effective. So that was just a summary of what you taught us, Radhika.
Perfect.
And so I will pass it on to Dr. Sameer and Dr. Kaushal for the questions, and they can take up the questions from the audience.
Perfect.
Thank you, Radhika. This was a really wonderful talk. I myself learned a couple of things from this. The most important take-home message for me was definitely there should be a good amount of liquidity in your asset management, in your asset allocation. Because without that, when you would require the real money, it will be tough to get in a couple of hours. So liquidity should be very important when you allocate assets. And the second thing is, as you said, that money is a very personal issue. I guess we should all take some time off this lockdown. I'd said it earlier also, to look into our financial health too. So let's all stay safe, stay calm, and stay invested too. So we start with questions.
Yeah.
Lots of them. So the first question is, this gentleman has some investment in stocks. He's asking which sector should be avoided as of today.
So you're sending me the equity questions, but I will take this question. My general view on this is that in times like this, especially with equities, we have a tendency to take a lot of action. So because markets are like this, and I get this sectoral question a lot, let's flip from this sector and, with no offense to healthcare, because COVID is there, let's move into healthcare. Then because oil prices fell, let's buy some oil companies and this and that. I want to make 2 points to you. One is that, it is very difficult today when even our medical professionals, and, I'm talking to the audience around this, don't know the impact of the lockdown and how long this is going to last, to make an accurate analysis of which sectors will be impacted. Obviously, hospitality, airlines, some of these entertainment, etc., will be adversely affected by that. You know that. But it is very difficult to make very conclusive and discretionary consumption. I mean, these things will be hit. Everybody knows that. But it's very difficult to make definitive answers. The second thing, and the more important thing, is we did this analysis at Edelweiss Mutual Fund that, if you try to do the sector timing game, that abhi healthcare mein invest karo, then there was an infra phase, then there was a power phase, then this, what were the returns you made? And, from 2007 to 2018, if you did that perfect timing, if you got all the trends right, I think you made about 10% odd. If you just did a diversified blended good stock portfolio, Nifty, etc., you made 11%. So this exercise gives a lot of happiness and a lot of entertainment, but it doesn't yield too many results, which is why I said resist the urge to take too much action. A very boring answer, but.
So which is the best type of debt funds would you advise if somebody has to invest for a 3-year horizon?
Okay, so if you are looking at a 3-year horizon, I recommend you look at 2 categories. I think my favorite category for a 3-year plus horizon is bank and PSU debt funds. Again, just to clarify, they invest in bonds of banks. So banks, nothing to worry about, and good public sector companies. So if you look at like Edelweiss banking PSU debt, any banking PSU debt fund, that is what you will see. So banking PSU debt fund, I think, is one of the nicest categories for a 3-year kind of horizon. The other good thing from a banking PSU point of view is that today, while your interest rates are coming down, there's something called your Government of India bonds. They are probably trading in the 5.5 kind of vicinity, 5.7, 5.8. They are giving you 5.7. But your AAA public sector companies, which are just a notch, I mean, they're the best rated companies, They are at 7. So as an investor, you have a big spread between Government of India and quasi-Government of India. Hence, it's a very good opportunity for investors in the 3-year plus bucket.
What
And
about
there is also the RBI bonds, which is now being advertised freely as 7.75.
Yeah.
So would you feel that that would be a better option and safe? Of course, it comes with the 10-year clause or 7-year clause or whatever. So there was a question as to why should we not be just investing into RBI bonds?
You can do a part of your portfolio in RBI bonds, nothing wrong with that. Just remember the liquidity angle and check the tax implications for yourselves on RBI bonds. I think you can't do either or. Fully RBI bonds will compromise liquidity. I think that's the critical thing. If you have a 10-year horizon and you know you're never going to need this money, then please, by all means, go ahead and do it.
And Radhika, could you tell us what are these gilt funds? Can an investor invest in it, a common person?
Yeah. So gilt funds are mutual fund vehicles, mutual funds that invest in Government of India bonds. Typically, the gilt funds that exist today invest in long duration Government of India bonds. Now, the good and bad part of gilt, and actually, I'm glad you asked this question. Gilt is sovereign, so it is Government of India, so there is no worry about credit. However, please remember that gilt has duration. So if interest rates, and if you look at the 1-year returns of gilt funds in the past, you'll see 15 and 18% and get very excited. Please do not buy a gilt fund thinking you're going to get 15 and 18%. You will not. Interest rates have fallen a lot over the last year. That may not repeat. Gilt funds are very sensitive to the movement in interest rates. I talked about duration risk for this reason. They have very long-term duration. And actually, the gilt fund category as a result is very, very small because most investors don't have the ability to handle that kind of duration. You don't realize there are days when RBI takes drastic moves and gilt funds can be down 1, 2, 3, 4% in a day. So please be careful. As I said today, if you look at gilt, which is Government of India securities, and one notch below, which is AAA public sector, your risk reward is in favor of AAA public sector just because of the way markets are. So that's just one feedback I'll leave you with.
So there's a question that, we have a varied audience. So there are some who are less than 40, there are some who are between 40 and 60, and some who are more than 60. So would you have some kind of a formula by which you would tell them, well, you must be investing only this much in debt, and the rest, if you want, you can go into equity? Is there a formula that you would use?
Conventional finance wisdom says that the formula should be 100 minus age, etc. I don't believe in that formula. I mean, I myself have been the victim of it. Obviously, as you are younger, you should be in more wealth creating assets. I mean, broadly, yes, you should be in more wealth creating assets as you're younger. And as you approach retirement, you should tone down the amount of equity in your portfolio and move towards distribution assets. However, it is a function of your circumstances. As I said, despite being young, if you are in very, very high risk professions, which are very linked to the market and very volatile, perhaps not having equity, too much equity is right for you. Some people, no matter how young they are, do not have a large risk tolerance. Some people have large liabilities and EMIs at a very young age. Some people in their older age don't actually need the expense for regular monthly income because they have a pension. My father is a government officer, so he doesn't have his monthly income needs because he has a pension that is coming in from Government of India. So I think circumstantially there is no right answer, which is why it's very important to do the exercise Dr. Kaushal said about sitting and planning this with your financial advisor one-on-one.
All right. A couple of our questions that have come in are linked to the Franklin India episode. So they want to know whether they should be painting all short-term funds with the same brush, or what is the criteria that you would put up. Like you said that for liquid funds, almost all of them are very, very safe. For the same maybe for arbitrage, but could you throw some light on that?
Yeah, fair question. And I think anything like this happens is not good for any MF investor. It's not good for our industry. So it's not an incidence that any one of us feels happy with, and we understand where investors are coming from. As I said earlier, and I'm glad you asked this question, I was hoping it would come up. I don't think we should use this to paint everything with the same brush. However, we can learn from whatever happens, and we should use it to ask more questions. So when you are investing in an ultra short-term fund or a corporate bond fund, you should look at, you should do a hard look on two things. One, look at the credit quality. In some funds, it is very obvious just by looking at the names of the companies and the rating of the paper that they are taking lower credit quality for higher yield. So they're not doing it for free. And others are not taking that stance that you should look at. You can also ask the advisor or fund manager, the particular episode in question is also a liquidity driven problem, which is why whatever happened. You can also check the liquidity of the underlying portfolio. So I think these are two questions that you can check. Again, as I said, please do not use it to paint all debt or all mutual funds with the same color, but do use it to ask better questions. That's important.
So Radhika, with every crisis, we have seen that the gold rates increase. That's the normal human tendency.
Yeah.
So at this point of time, would you throw some light on investing in the digital gold as debt options or in real estate to balance out your portfolio if you want to exit the equities and the mutual funds?
Okay, I'm going to skip real estate because I'm not a real estate expert. I'll give you my comment on gold. I think, as you're saying, in every crisis, we get very excited about gold and we say, I should buy gold. 2 points. I think you can invest in gold, whether physical, financial gold, we can come to that. However, gold should be a part of your asset allocation. Don't invest in gold in a crisis because like you can't time markets, you have no ability to time gold prices. So if gold wants to be a 5-10% part of your allocation to hedge against volatility, it's a hedge against the currency. Gold, assets like foreign equities, these can be a part of your portfolio, but they should not be a part of your portfolio because we are in a crisis or Indian stock markets have done badly. They should be a constant 5-10%. They should be part of the asset allocation. So once you get your equity and debt right, I think gold and international equities are the next two assets that you can definitely look at. In terms of financial gold, the easiest option, gold bonds are an option. I like gold bonds. Again, for a certain amount, if you don't need the liquidity. The second option is a gold index fund or a gold ETF. I mean, if you're investing in gold, financial gold is better than physical gold, and either of these two options.
Radhika, I think the last question as regards debt instruments is one again related to the same thing that everybody says that, well, there is no liquidity crisis, it's a solvency crisis that's coming up. So
okay,
if we decide that, well, if the corporate earnings are going to be very poor, so do you think that certain there's be more credit risk in taking even a AA bond or of course a AAA, maybe the government bonds, but in a single A or a AA bond, would that be a risk? Because if the corporates start going bust, then what happens?
So I do agree, and that's why I repeat it again and again, AAA, public sector, good quality borrowers again and again. I do think we are in fragile economic times, and could you see more credit defaults, downgrades? One wants to say no, but our environment's fragile. Of course they are. Liquidity, let me also comment on liquidity. Liquidity is challenging in the AA and single A segment. It is very challenging today. I run a very, very large bond ETF, one of India's largest debt funds actually. In the AAA segment, I'll tell you, even in the last 2-3 weeks where RBI has significantly condensed trading hours, we have 2 hours of trading, we are doing 500 crore subscriptions, 500 crore redemptions. And in the AAA segment, we have not had a challenge at all. So I think good quality borrowers should sail through. AAA borrowers, I don't think, especially the public sector ones, should sail through absolutely fine. In Bharat Bond ETF, that's something I've seen absolutely clearly, that we've been able to process subscriptions and redemptions without any challenge because it's the highest segment of borrowers.
Yes, Radhika. So I think we have touched upon most of the common questions. Thank you very much. The other ones on equities, we'll direct it to Mr. Raamdeo when he comes.
We have already more than 800 people who have logged in, and there are lots of questions, some of which I think we can take on later on, because we have our next speaker also ready to give us his talk. So thank you very much, Mr. Radhika Gupta, for that very, very enlightening presentation.
Thank you so much. And again, compliments to all of you from the team of Edelweiss and Edelweiss Asset Management. Thank you for giving us the opportunity.
Thank you, Radhika.
Thank you so much, Radhika.
Thank you. So, friends, our next speaker really does not need any introduction. He's such a familiar face on many business channels. He is an equity tycoon, and he has charted his journey with his pal Motilal Oswal as a sub-broker and co-founded the Motilal Oswal Financial Services in 1987, and has moved a long way in his journey from zeros to billions, if I may say so. He is here to throw some light on the current market dynamics about what should be done with your equity investment and how you can make the most of it. So, ladies and gentlemen, please welcome the MD of Motilal Oswal Financial Services, Mr. Raamdeo Agrawal. Good evening, sir. Welcome. He's on mute.
Sir, you have to unmute. Raamdeo ji, you need to.
I'm on iPhone. I'm just trying to shift to laptop. Anyway, I think let's do with this only. Is that sound clear?
Yes, very clear.
Okay. So, good evening, friends. It's pleasure to talk to all of you. It's a very interesting time, very challenging time. And I was just, before this, I was talking to somebody, and he was saying that, why don't you speak about your journey and this and that. I said, boss, the ship is right in the middle of the storm, and we don't know whether how long and how intense is going to be the storm, in what shape. खाली हाथ पैर टूटा हुआ निकल गया तो बहुत अच्छा है, मैं बोला, because this is a very unusual time in my 35. See, because as a businessman, as an investor, you are into continuously risking your assets. You are not into a guaranteed zone. I mean, you must fundamentally understand that businesses are risk, and equities are risk because you have bought pieces of the businesses. So every business has its own set of risks, and you are in a risky asset class, and the risks have a way to compound itself, particularly in this kind of times, and things go complete haywire, and this comes from somewhere which you had never imagined. Like on 1/1/2020, when we celebrated New Year, I don't think anybody mentioned the name called Corona or virus, or it can take the whole world economy down. I don't think anybody talked about that. And even I think when Mr. Buffett wrote his newsletter, I think he wrote sometime in February late or something. I don't think he had any clue. And today in April, May, the whole thing has completely gone upside down. And so I think the latest event is what happened on 2nd May. There was a AGM speech, which we cherish listening to him for last 25, 26 years. And I have been, for me, he is a guru. And he changed my way of thinking about the stock market. And he has not only changed my thinking, but he has changed the entire world's thinking, let me tell you. I mean, he is the actual Sadguru of equity markets or investing per se, and investing in fair way. And there is no discussion anywhere in the world without his angle being presented to any issue. So he has, so everybody looks forward to what he has to say, because he has a uncanny style of looking at things in a, I mean, completely simple way, and yet in a different way. And this time, I've been going there for last, I started going in 96. And since then, I've been there almost 22, 23 times. 2-3 times I have missed. And I actually cherish going there. This year we couldn't do because the whole thing is broken down. So, he took the pain of putting up 12, 15 slides on the history of America and history of the markets, which is unprecedented. I mean, he never writes anything anywhere except for his own annual reports. And this is the first time on the markets he was presenting. And I mean, see, nobody knows the future. He says that we are into biggest unknown. I mean, for him, for his 90 years old, it is the biggest unknown he has ever seen. So let's take it on the face value. So we don't know how the future will unfold. But we have the probably history to guide, and he's recounting the history. So if you ask me how well you are going to do in the future, I don't know how well I'm going to do. I never knew 30 years back that I'll be sitting here and talking to 700-800 doctors here. So that's how the future is. Yeah, I mean, nobody knows what is there in store for anybody, but you can draw some conclusions from the past. So he went about of American history, and more particularly coming to the mind, he said what all came on the way of whether it is civil revolution, whether it is drought, whether it is swine flu, everything America has passed through and has become the world's greatest power, and the kind of economic machine it has created. So he says that don't bet against America. That was his basic message. So he is long-term bullish on America. So that was the one backdrop before giving his bearish, kind of a macro call. And let me tell you, just for the this thing that I mean, he has taken pain to give that macro call. And first instance he mentions is the 1929-1930. So at that point of time, what happened was there was a bull run in US like current time, and in 2029, I think Dow went to about 350, and from there it crashed to 200. And as it crashed, I mean, you can imagine after almost 40-50% decline, the markets went up from 200 to 250, 22-25% pull up from that 200. So everybody thought that yes, there was a problem, there is a problem, and hence it is taken care of by the market decline. And from that 240, 250, in next 2 years, it went to 41.22. I mean, he had mentioned that decimal also, 41.22. This is 82% correction. I mean, why he has to mention this? Because he fears that there is a possibility that we could be in that kind of trap where the perception and reality doesn't match. What is happening on the ground, the kind of damage. I mean, can you believe we cannot cross the continent today? There is no way, there is no airline. It's all broken. Everybody's bankrupt. All the flights are suspended, and your own people cannot come back from there. So this is unprecedented in the history of world economy. Your public transport is fully suspended here, and whole lot of things have been. See, fundamentally, the world is locked down, and it is not designed for lockdown. Fundamentally, world is not designed for lockdown. Like a hospital is not designed for lockdown. Same way, the world system is not designed for lockdown because it is designed around human being, and human being is not locked down. We are not locked down. We are doing conferences. We are doing conferences more than ever before. Thanks to Zoom, I don't think I have in my life, entire 35 years of history, I would have ever done in 40 days as many calls and as bigger a call as I would have addressed about 1 lakh participants in last 40 days or maybe more. So, this is unprecedented, and human being cannot be locked down. Now, human being, the very nature is consuming. I mean, the आपका रोटी कपड़ा मकान पूरा चालू है, including 4G. So that consumption is on full time. But what is out of the window is the discretionary consumption. Whether it is big fat Indian marriages, whether it is going to theater, whether shopping for the fashion, whether it is going for tourism, going to Europe for holiday in this summer, they're all gone, absolutely out of the window. Now, India is an economy of essentials. It is not a rich economy. It is economy of poor. And our per capita GDP is $2,000 per capita. Of that, I would think 70-75% is around essentials. Only 25-30% is for discretionaries. Whereas America or any country around America, Europe and all, they are just the other way around. They are economy of discretionaries. That's why they are called developed economy. We are developing economy, emerging economy. So there 75% is discretionary, only 20-25% or even lower is essential. So for them, the damage is far deeper and it will take a much longer time to get up and running. Because what is once broken is broken. I mean, and bigger the discretionary economy, deeper is the borrowings. The debt to GDP is much higher. Like in US, the debt to GDP must be 2.5 times of GDP. So if the GDP is $20 trillion, their debt must be running into 40 to 50 trillion dollars. Whereas ours, because we are not developed, the guy who is not developed, his loans will be lower. You see the borrowings of the rich guys are highest. The guys of the poor guys, I mean, who wants to give him the loan? So basically, so we are the country of essentials. We are the country of poor, and hence we will bounce back quickly. But right now, the extent of damage which is happening as it is getting prolonged, I mean, 2-3 months. I am actually in Abbey Valley in Lonavala, and I had come here for 2 days at the weekend, and thanks to lockdown, I got stuck here. So that was the first lockdown of 3 weeks. I was, for that 4 hours between 8 o'clock in the evening and 12, I thought I will drive in the dead of the night and come back home. Then I said, whether I'll die with the corona or not, but I'll die of the road accidents. So I said, let me just stay home and not bother about coming here. We'll find some way of coming back. And that's how I decided to stay back. And I decided to stay back, and I'm here for already 47, 48 days. And it looks that people are now talking in months. May is done, June is also, now people are talking about it. So I don't know, I think we'll retire only here, it looks. So this is the nature of the problem, and you all are doctors, you know better than me. I mean, I don't know the difference between lung and heart. So for me to understand the impact of COVID, and whether only the summer will kill them or it will just disappear on its own, I don't know what is going to happen. But we are into completely unknown. I mean, any possibilities can happen. Only after it is done, when vaccine is found, it is dead, then we'll start counting what has been that, and how it went through, how we won over it, and some heroic stories will come, and some scientists will be given Nobel Peace Prize, whatever. But those are things yet to happen, and there are a few months, so we don't know meanwhile what damages are going to happen. Now damages are from leverage is going to be the biggest source of trouble, because if I'm running a theater, I don't have a business, that is one thing. But now I have to service the loan I have taken to build a theater, and that loan meter is not stopping, and hence it is a problem for the guy, and it is a problem for the guy who has lent that money, the bank or NBFC, whosoever has lent. So clearly, and if the NBFC goes down, because if the theater goes down, then NBFC goes down. If NBFC goes down, then the bank or mutual fund lend of the risk in the current situation is one leads to other. You don't know what is going to be the end effect. And that's what Buffett is saying, that the nature of risk cannot be determined, because it is not a one level risk. Say like with the lockdown, what happened was that worldwide oil consumption has come down by 25-30%. Nobody knows what is the number, but definitely 25-30% oil consumption has come down, because there is no driving all over the world. Now, world oil market is about 100 million barrels a day. The consumption drop is about 25 to 30 million barrels a day, and they are pumping like mad. And now every single available tank is full of oil. What happened? The oil crashed from $65 to maybe $15-20. That is understandable. But in the futures market, oil crashed to minus 37 or 38. That led to, I mean, so many hedge funds going bankrupt, so many traders going bankrupt. And they going bankrupt is one thing. It is impacting even the brokers whose account, who was handling account of the trader. So, I mean, for the no fault of, I mean, something going below zero is unthinkable. So that's the nature of the risk. I mean, these risks, I mean, nobody ever thought that anything can go below zero. So what I'm saying is that a lot of people will think that isse zyada kya hoga, usse zyada kya hoga. I mean, after 1 year, we will recount what all went wrong. And if nothing goes wrong, very good, celebrate. So I think this is not the time to celebrate. This is the time to pass the storm peacefully. One has to be very careful with the money, and particularly when you are buying into risk assets called equities. So if you have invested in the stock market already, I mean, everybody must be having the portfolio today. So those who have the portfolios, they have to make sure, they must audit their portfolio, whether they have the right kind of stuff or not. Because what is going to happen is, in next 1 year or so, because of this, all the difficulties, a lot of companies will fall by the wayside in every single business, whether it is cement company, steel company, you are a theater company, tourism company, airline company, broking company, wealth, you name it, everywhere the weak players who are at the margin before COVID, they will shut the shop or they'll go bankrupt. Now, how many of them are there? I don't know. And how many more will undergo? I don't know. But I know one thing, COVID has come, it will go. Whether it takes 6 months, 1 year, 1.5 years. Longer it goes, longer it takes, more and more casualty will happen. And not a single new business is going to be born during this period. So you are going to come back on the back of the same, say out of 100, if 30 are dead, you are going to come back on the back of 70 businesses, not 100. So, and I'm quite sure 2020-21 is okay, wash out, but 22, 23, 23, 24 will be fine. We'll come back with a vengeance, I can tell you this. The world will come back with vengeance. That has happened in the past, it will happen this time also. Our economists, our central bankers, they are very smart. They have upfronted all the fiscal monetary benefits, and they will do even more to put the fire into the economy. But let this COVID damn thing go away. Once this goes away, the recovery process will start, and we have a lot of technology in the right time to do it. So it will happen. It may take another year or so, but it will happen. But when the economy comes back, which is what the optimism I have in me when I'm talking about equity markets, at that point of time, there won't be 10 guys, there will be only 6 or 7 guys. And hence the best guys will have disproportionate market share in every business. And they will not know from where the clients are coming, because there will be shortage of supply of good services in every field. I can tell you this, every field. So you have to buy quality businesses, quality management at reasonable prices. And if in your portfolio, even now you realize that you got some junk, throw it and either sit on cash or put some quality stuff in that. And this is for the people like me who are fully invested, who don't have single penny to put further in the market. So we can only rationalize our portfolio. And that's why I was knowing when I was saying QGLP, quality and growth, because I know quality works in good times for sure, but quality works the best in bad time. You are buying quality not for good time. In fact, the bad stocks, they do very well. In fact, better than quality, better than good stocks in good time. The bad stocks do very well in good time. It is bad because they don't do well in bad time. So this is the bad time. This is the bad time when the good companies will do well, but bad companies will do absolutely horrible. So if you by chance, I mean, despite all the smartness and talking and this thing, you'll always have some problem of, what you thought earlier was good, turns out to be bad. You saw Warren Buffett. For 20 years, he badmouthed airline business as the worst business in the town. And then he became bullish on the businesses. And by hiding his face, he bought 10% in all 4 of them, 4 or 5 years back. In fact, people are asking me why the hell the old man is buying airline. When all 4 of them, they went bankrupt. And he sold all of them 100% at a loss. And he said, there's no mistake of the management. It is my miscalculation of the badness of the businesses. So this is the nature of the thing. So if you realize something is wrong, just clean it up. That is what the learning I have from what Buffett is saying. So what is important is that we have to be very careful and what money we are left. And second is that fortunate people like doctors who keep getting cash flow every day. They must be having cash flow which they can put up now. So there you have to be extremely careful that yes, when the world is fearful, we must slowly walk in. But this is not the time to put out everything. This is the time to put out of 100 rupees, 10, 15 rupees and just watch. And just after 1 month, another 15 rupees. Market goes lower, put another 15 rupees. Market goes lower, put another 15 rupees. Market goes higher, then also put up 15 rupees. So this, during the pendency of COVID, 6 months, 1 year, I would guys to figure out how long it will last. But during the trouble period, make sure that entire cash is spent, but buy smartly. And that's where I think intermediaries' role comes in advising what to buy and whom the money to be given. If you don't understand anything, you want to make, you don't want to take any manager risk, go and buy index ETFs. You can buy S&P 500, you can buy NASDAQ, you can buy all the indices of India, Nifty, S&P 500, mid-cap, whatever you want to buy. That's where the advisor's role comes. And bulk of the money you're not going to make because what you bought or sold. You are going to make because in which asset class you are there. And typically your fixed income will make say 5%, your equity will make about 10 to 12%, 2x of the fixed income. That's how long term it works out. And for the double return, you have to take the risk. I can tell you the risk is real, and now it is visible that what is the risk. And I have seen in my 35 years, 3 times I have seen 60 to 65% decline in my portfolio. So you have to have that courage to see decline in the portfolio. Just because you're buying today, it doesn't guarantee you that your 100 will never become 80. You should be comfortable even if it goes to 50, so long as what you're buying you are comfortable with. So that's the nature of risk. There is no guarantees about this thing. And if you're not designed mentally to see losses in your portfolio, then don't come to the equity markets. You are better off with that 5% debt market. You have already done the hard work of earning money. You don't need this extra 5% and burn your heart. So you can stay in whatever asset class you are comfortable. Do in investing, one thing is very clear. Don't do something which you don't understand. Please do something you understand. So I think it is very simple at one level, because everybody has the brains to understand what he's comfortable with. My job is only to kind of highlight the risk in the asset class, and I hope I have scared you enough of the asset class. And despite that, if your intermediary says that you are designed for this and you have you have the courage to see some decline, because this is the decadal cleansing, and it happens once in 10 years for some reason or other. And then after this, you can put a blinds on your eyes, and you can drive at the speed of 200. Nothing will happen. But before that, there'll be pain. Now, whether you can sustain this pain, can you see the quotational loss in your portfolio? That's something to mull over. So I would close my remark with this, and we'll take few questions so that you can connect with what you are thinking. Thank you very much.
Thank you. Thank you so much, Raamdeo ji, for the wonderful session. And thank you for taking out your time and spending time with all of us. So I will just summarize what you said if quickly into 4 to 5 points, just in 4 to 5 points. So first thing is very sure that one must not do anything that one doesn't understand. So don't do something what you don't understand. It's a good time for you to throw your junk investments. You cannot really think of keeping something which is not a good quality. India has 70% of the spends on essentials and only 30% into discretionary. So India, in a way, is insulated, and it will be back quickly. Nature of risk is absolutely unknown post-COVID, like the black swan that we have seen currently. Biggest unknown is ever seen. And Warren Buffett's message is don't doubt on America. So the way you said about India, I just feel that one must not even think of doubting India. But it's wise to go very slow. One must not put everything at one go, given the current market situation. Take small little baby steps and do your investments. Buy quality business, and importantly, rely on an intermediary or an advisor to make wise decisions for your financial portfolio. So that was just a quick summary of the things and the wisdom that you shared with us today. I will hand over back to Dr. Samir and Dr. Kaushal for taking up the questions from the audience. Thank you.
Thank you, Raamdeo ji, for that brilliant insight into what exactly is the scene, not only at the Indian level, but also at the global level. But, and as you mentioned that, you've spoken to almost 1 lakh investors. I'm sure most of them would have asked you the same question that I'm coming. You said that the ship is in rough weather. Well, sir, ships are safest when they are docked at the harbor, but they were meant to sail in high seas. So do you think that you did mention that right now is not the time for any fresh money to be allocated in one go? You put it into small tranches. But the question that I have received is a very pertinent one, that today, if the investor does not have any money, no liquidity, should he liquidate a small part of his portfolio, 15 or 20%, and wait for the index to come down to 7,500 Nifty and then start reinvesting? It's a long question, sir.
So you're saying that if somebody is already invested, should he book profit now and wait for 7,500 to come?
Yes, because
if I was knowing, if I was knowing this, I would not have been talking to you. I would have been shorting the market only. So see, there is nobody on this earth. I mean, nobody on this earth, Brahma, Vishnu, Mahesh plus Warren Buffett put together can figure out where the market is headed. Let me tell you, it is all guesstimate. We are all drawing from our past experiences. He is also drawing from 1929. It was a different world altogether. He was just about born in 1930. And it was a completely primitive economy in the sense that the understanding the macroeconomics, understanding the concept of money, the size of the economy, the consumer behavior, the communication of the entire thing. There was no internet, there was no radio, there was no television. It is very difficult to communicate with the consumer. There was only fear all over. And in fact, they ended up doing just the reverse. If I understand a little bit, I think in the past, I think why this time US did absolutely front ahead of the curve. Why they front loaded this thing stimulus? Because this is what exactly was not done in 2008. They did it, but they did it after 1 month. In 1929-30, for 10 years, they actually constrained the economy of the liquidity. And that's why this action is just the reverse of that. So, so there is so much of understanding of economics right now, and there is no gold standard. This is all paper money. So it's a very different kind of situation. Yet the old man, with his wisdom, he thinks that it is not about money. It is about the fear. It is about the fear of COVID. Now, see, if you put few more crores in my pocket, still my consumer behavior doesn't change. I'm stuck here. So the point is, money is not going to solve the problem. It's a health-related issue. And in the mind of the people, the fear of COVID is such that it, as if it is a fear of cancer. I mean, if it is caught me, I'm dead. I mean, is that kind of fear? At least the politicians, they think they're scaring the people with that kind of thing. And with 98, 99% recovery in India, or maybe even more, I think it's a very different kind of nature. But you can't do anything. I mean, the world is locked down. Not only India, the world is locked down. It is a consumer behavior is like that. So with that, he's saying that Great Depression per se did one thing, but it changed the mind of the people. I mean, the consumers at that point of time. So the citizens started saving. I mean, you cannot believe at that point of time, people thought the equity dividend yield in 1950s were higher than the bond yield of the market at that point of time. You needed to give more dividend because you are buying into risky assets than the bond yield. Then later on, people realized that, boss, these guys, they don't distribute everything, they save, they plow back the money, and that's why equities do well. So it took 20-25 years for the market to come back. That is what. So what this COVID will do now is going to change everything. And hence it is very difficult to predict what is going to happen. Is the market going to go from current, what is the number now? What is the Nifty level now? 9,000 something?
Yeah, around
200.
Yeah, 9,200. So from 9,200, it is going to go to 10,000, 12,000, or it is going to go to 7,500. I have no clue. I wish it goes to state 13, 14,000, so that we all go laughing from here. But we don't know. I mean, actually, so that's why I would not encourage, because this is the question everybody's asking. Because my pitch is a little bearish. So, but I'm not sure about it. I can make a pitch which can be very bullish. That's what I've been doing for last 40 years. But for last 40 days, I'm a little bearish. I mean, bearish in the sense that we don't know where the hell we are. So I'm saying that where you are. So I have a kind of a stay put for what you have invested, but be cautious about the incremental investment. But on the whole, I'm bullish on the longer term of the Indian economy and the world economy.
Sir, there's a question.
Yeah.
So in most of the sectors in the equity, it is the blue chip scripts which have taken a good beating as compared to many mid caps. So now when the market is down, should we invest in the mid caps or stick with the blue chips? Because as you said, quality works best in the bad times. What would be your take, sir, on this?
No, I will again go back to the simple thing. What I understand, I will do it. मेरे को अभी यदि लार्ज कैप अच्छा लगेगा तो मैं लार्ज कैप खरीदूंगा. मेरे को स्मॉल कैप अच्छा लगेगा, मेरे को समझ में आता है यहाँ पे बहुत धमाल है, I'll buy that. And I will, till yesterday what I said is right, I can change it tomorrow. As the data changes, I will also change.
Right.
So, but then the one thing remains, जो मेरे को समझ में आता है वही मैं करूँगा. You know, so and that is the nature of the situation right now. So it is, I'm quite sure it is not about, if you want to buy a telecom company, tell me one mid cap or a small cap telecom company. You have to buy large companies, you know. So, and then opportunity I see is in telecom right now. If there is one sector where I see a brighter opportunity, something which will come out with a higher sales and higher profit out of COVID is going to be pharma and telecom. There's no third business. So if I want to buy a telecom, see now, they're not, in this kind of time, you're not going to get many opportunities. If you're getting one opportunity and उसके लिए बोलोगे नहीं नहीं अभी तो मेरे को लार्ज कैप नहीं खरीदना, खाली मिड कैप खरीदना है, तो फिर घर में बैठो फिर आप. तो उसी कारण से क्या है, ये सब ये डॉगमा पालने का नहीं, सब ये फालतू की चीज पालने का नहीं कि भाई मेरे को ये खरीदने का वो खरीदने. जितने आप फिल्टर्स डालोगे उतने आपके अपॉर्चुनिटीज कम हो जाएंगे बाजार में, और ऐसे भी अपॉर्चुनिटीज कम है. सो फोकस ऑन व्हाट यू अंडरस्टैंड and where you think in next 5-10 years it is going to be 5x or 10x, 5x or 10x, you know, and then go ahead.
Right.
We had a very nice presentation on investment in debt instruments. So the question is that should we be investing into very high dividend paying companies, particularly, but they are, most of them are the PSUs. So if you are going to get 8 and 9% with the high dividend companies, are you justified in investing in that? And the next question is, will these companies continue to pay these high dividends next year when the returns are the profits are not going to be that much?
But if you buy a basket of them, I mean, if you put everything in one company, then there could be a problem. Then you have a concentration, problem of concentration. But if you buy 10, 15, 20 companies of 7-8% kind of dividend yield, I think broadly it will work out. It will not give a lot of capital gains, and typically it works well. I mean, I'm not, see, that is a deep value investing. Oh, that is not in my style, but it should work. Don't focus on one company or two companies. It has to be a basket of companies. And then I think it should, I mean, one or two of them will definitely go under, they'll become bankrupt. Because just before dying, this kind of yield comes. So clearly, I mean, apart from yield, you should also focus on a little bit of health of the company. You know, how big it is, how monopolistic it is, how stable it is. There is a thing called Lindy effect. I don't know whether you guys have heard about it. Lindy effect is something which is, there is a cafe in New York, and where it is said that the companies, actually it is in Broadway. So there they say the longer the play is successful, longer is the possibility that it will remain successful. So if it has done 100 shows, most likely it will do another 100 shows. And if it has done 300 shows, most likely it will be good for another 300 shows. By seeing 3 shows, you cannot say it will last for 300 shows. So like that, in yield, when you buy high yield companies, you got to see for how long these companies have been around. If they are 30, 40, 50-year-old giants, monopolistic, I think next 25, 30 years will be good for them. So I would be little, you know.
Which means you are saying that first look into the fact whether that company will remain solvent in the next couple of years.
Yes, that is a COVID basket.
Right. Sir, one another question is that there is a lot of talk going on that since a lot of companies in the world are going to shift out from China, in fact, countries will move out of China with their operations. Do you think, which sectors do you think are going to be good from the point of view of their businesses being shifted into India? So one day people are talking about the specialty chemicals, about pharma. So are there other sectors that you would recommend?
See, it all depends on the government of India. There is nothing on this earth which China can do well, which India cannot do well. Our entrepreneurs are smart. Our cost structure is very, very competitive in a lot of businesses. I think the infrastructure is the only gap where there also we are caught up quite a bit. But infrastructure is one thing where we could be lacking. But now the labor cost per hour let me give you some statistics. US per hour labor cost, apple to apple, I'm saying, is about $60 per hour. 60. In China, it is about $3.50, which is now moved to about $4. In India, it is sub to $1.5, $2. So we are really, $2,000 per capita. You're talking about $1 or $2 per hour, because a person works for at least 2,000 hours per year. So you are talking about average cost of the labor, not more than $2 per hour. So clearly, we have an edge. We have scientific edge, we have education, we can design world's most complicated software like Aadhaar card and those kind of things. Question of our competence and sophistication. The issue is, are we a pro-business society? The problem is, we are, as a nation, we have got into so many things like this mid-cap and large cap and all. There are so many, kind of filters. Large business,
I think we've lost the voice.
Yeah.
Hello?
Yeah, we are back here.
Yeah. We'd lost your voice. Now it's fine.
Yeah, I think this internet is troubling. Hello?
Yeah, we can hear
Are you
you.
fine?
Yeah.
Yeah. So let me just put the video off. Just a second. Yeah. I'll save some bandwidth. Yeah. So what I was saying. Yeah. So it's about the Chinese, foreign companies coming into India. It's all about our mindset. Are we welcoming job creation? Why about foreign companies? What about our own companies? Where are those small businesses which used to be in the morning walk? You used to get one textile processing company, one textilizing company, one small company here and there. I think that entire movement to get into businesses have gone completely in dust. I think our small mid-sized businesses, they're all suffering because somewhere regulations have overtaken the development of the businesses. And I think that attitude at a national level has to change to attract these guys and allow them to prosper. Because what is going to happen is that we have to promote the companies which are already doing something. Say somebody is doing 100 crores and he's struggling. We have to make that particular business profitable. And once the profit comes, the world will pile on here. So when I was in UP, when this guy, the young chief minister was sworn in, Yadav, kya naam uska? Akhilesh Yadav. So he called us and we went with 20-25 FIs to meet him and in his darbar. So he asked, Raamdeo ji, hame kya karna chahiye? Typically in a UP style, hame kya karna chahiye? So मैं बोला, भाई देखो, आपके यहाँ जितने businesses हैं, you are the sugar king of the sugar belt of India. So जितने भी sugar companies हैं, and they are all in the sick bed. They're all dying. If they are dying, how will you get new guys to? They are the guys. If they prosper, they will bring 10 more guys in. So what is important is for India right now is to make those who are already working a very profitable venture. If we become pro business minded, which I would say is a big challenge in India. All put together, not only the politicians, but the regulators, the district authorities, the local authorities, everybody, police, all of them, they have to become like the way they have come together to fight COVID. We have to come to fight the job losses. Once that environment is there, the world in any case will come here to do it. There's no better place. It could be the decade of India. Let me tell you, the last 2 decades have been decades of China. Now the world is fed up with China. They want new China to come, and that is India. That's a possibility only if we make it happen.
Yeah, Kaushal, you have a question?
No, I guess we have touched upon all the questions and sir has answered most of the queries and doubts.
Maybe we can ask him one or two macro issues if he can put his views on that. Raamdeo ji?
Yeah.
Yeah, so one of our viewers is asking that like in US, where they have been printing money and $2 trillion has been the package that they have given. Do you think that the government of India should worry about the fiscal deficit, but instead of that, just give a good economic package so that the people are able to come out of this? And the second question is also a very pertinent one, that in 2008, which was basically only a financial crisis, now it is a health crisis gone into financial. The interest rates were very high at that point of time, and now they are low. So does the RBI have enough ammunition to do something?
Yeah. See, I don't understand macro. I'm a chartered accountant, so I don't have good fix on how to think about macroeconomy. These are very complicated stuff. I would not like to venture there. We keep hearing the most complicated guys like Raghuram Rajan, and I mean, there are a lot of smart guys. I mean, they're applying their mind. Listen to them about that, and if at all you can get some clue. I mean, it's not worthwhile listening my view because actually I don't know. I mean, whether they should. When I hear the government economists, they say that we will go in a calibrated fashion. We are not going to go for a big bang, and I mean they have shown their way in last 45 days, 50 days. We have not seen anything worthwhile coming. So that's the way they think is right. Whereas the outside, everybody outside the government has a very different thought. So who is? I mean, I would actually admire the government authorities that they are doing a lot of thinking on this. That they are not being pushed by the outside agencies. So whatever their challenges are, see, I had an advantage when they were going for lockdown. I was not in favor of the total lockdown because I could see a lot of things breaking down because the system is not designed for lockdown. I'm not against any kind of whatever you do for the social distancing or COVID. I don't know anything, but lockdown was something which could have caused more damages than, and I was very clear about it. But that was 45 days back. Now government knows what all has gone wrong by lockdown, and the challenges, the pains, and then sufferings of the people, particularly poor people, and everything breaking down, all the workers going haywire. So now government has gone bankrupt. Can you believe this? The government is opening a liquor shop first. I mean, this is the crazy thing. All over the country, they are opening a liquor shop. Why? Because they can get few crores from this thing. The most patriotic thing is to drink. So so that you can help the state governments, and central government cannot help the state government. So how they will help you and me? I mean, that's since I'm a finance man, I could see that indirect taxes will go zero. That is for 2-3 months, but direct taxes is gone for the year, because what losses you'll make for the quarter, you set off against what profit, if at all, you make in next 3 quarters. So you will basically not pay any taxes. So the government will be shocked when they will see that the dramatic drop for the year in the direct taxes. So that we could see that this is going to happen, and hence it brings its own fiscal challenges. I think 3 to 4% of GDP will be drop in the fiscal collection itself. So what was 4% central fiscal deficit, in any case it is 7-8%. You'll just see, and on top of it you want fiscal stimulus. So I don't know how much they'll do it. So I mean, now this 3% drop in the collection is almost guaranteed. It could be even 4%, I'm telling you. So we get roughly 12% of GDP as by way of taxes. उसमें से 3% तो 3 महीने में निकल जाएगा. Forget about rest of the year. I don't know what happens. So clearly these are very challenging times, and even macro guys have no clue, because if nobody knows what is going to be the end game, how do you estimate anything? So everybody is putting their numbers, and the biggest fraud is IMF. Let me tell you, they have no clue. They are supposed to know. They knew their stuff before joining IMF.
Have we lost
so much on the face value, even what they say? Hello.
Yeah.
Yeah,
we
So-
had lost your voice. I think now it's better.
Yeah. So I think you have to be very careful in taking all this macro guys forecasts. You know, they are. I'm useless for this, but they are also not much better.
Raamdeo ji, coming back to the present market scenario, like in 2008, do you envisage a second huge fall?
I'm just being cautious. I'm telling you. I mean, this is the time to be. I don't want to be caught unaware.
Right.
I would rather not speculate. Yeah.
So should we be sitting on whatever cash we have, or should it be invested right now?
That is what is the advice of all the wise people. Whether Deepak Parekh, I would consider among the wisest people out of India in financial markets, it is Deepak Parekh.
Right.
And you see his tweet. Now, if you don't want to follow anybody and you think you are smarter, then you go ahead. If Warren Buffett is not good, Deepak Parekh is not good, Uday Kotak is not good, Mukesh Bhai is not good, then boss, फिर हम ही लोग फिर सरताज है ना फिर किससे सुनने का फिर?
Thank you, Raamdeo ji. This was a talk, I think, directly from the heart, and a very frank assessment of the current scenario and what is going on. You have very beautifully summed up what the situation is. In medicine, we always say that hindsight is always 20/20. You can always comment on whether you went right or wrong once that event or that era has gone. But unfortunately, this year is 2020. So, but I'm sure that our listeners are now far better equipped to set sail on their financial journey. Maybe the waters are turbulent right now, but this time too shall pass. We are all optimistic about that. As medicos, we are doing our best to be able to get our brethren, everybody, to safe waters, to safer shores. So thank you very much for giving your time and explaining to us what the exact scenario is.
Thank you very much.
Yeah, I would like to also thank all our viewers who have been glued. I think the number has now crossed more than 1,000. And Plantrich has committed that just like in the first session, they will format things in a couple of days, if not by the end of the next week. And they will revert back to you individually with their replies to questions that were unanswered today. And a reminder for everybody to leave their feedback for both these sessions, because that is what will tell us exactly what we can do if we want to plan another session on how to rewrite your money story. So with these few words, I'd like to thank you once again, both Plantrich also for putting things together, and to all the viewers for spending the last 1.5 hours with us. Thank you.
Thank you.
Thanks.
Thank you so much. Thank you, Raamdeo ji. Yeah, I think people have left. Now it's all Rahul. So Rahul, are we all good? Can you tell us the...
Are we live?
Yeah, I think we are still. I can...
Rahul?
I think we'll close session.
Yes.
Yeah.
Close the session.
Yeah,
Thank you.
Thank you. Thank you, Kathy.
Thank you very much, Kathy. That was an excellent session. Yeah.
Thank you.